and insightful exchange. The stage is yours, gentlemen and ladies. Thank you.
Thank you so much. Okay, great. Firstly, thank you to Cyberport and FinTech and the World Green Organization for inviting the Hong Kong Green Finance Association to moderate this panel. Just by a quick way of background, the Hong Kong Green Finance Association, we are 160 members strong association, non-governmental, not-for-profit, and really kind of like our mission and vision is to position Hong Kong as a green tech and green fi center. And we are uniquely positioned as a platform for and dialogue between regulators, government, and private sector. So I think we've heard today, earlier, in terms of the size of the financing that's required to transition to net zero, it can be up to around about $170 trillion. And that's an estimated $4 trillion each year that's required between now and 2050 in climate solutions, emerging green technology, green fintech, and innovations across all industries and sectors to decarbonize. This is kind of like a very substantial amount of funding that cannot be kind of like provided by the government and public sector alone. And so we really need private sector financing support. So when we put the lens into Hong Kong and where we are now, Hong Kong is really leading Asia's efforts to mobilize this financing. And in 2022, it had $80 billion of sustainable debt that's outstanding. And it's one of the largest Asian sovereign bond issuers and leading product innovations we heard from the previous panel on green tokenization, the multi-currency, longest duration, inflation green bond, etc. So, as a super connector to mainland China, I think Hong Kong plays this crucial role in terms of leading the way in implementing demonstration projects, building a green ecosystem. So with that as a brief backdrop as to where we are now with green finance, I'm delighted to introduce my expert panel speakers to look at where we are going forward in the next 12 to 18 months to gather their insights. And when we were talking just earlier, I figured there's really no need for too much introduction except for the fact that the combined financial experiences probably equates to 100 years if I was to really add this up together. And we're very delighted to have both Justin and Jason who've traveled from the UK to be with us here as well. So with that, I think we have heard in terms of tokenization earlier, as I mentioned, in terms of mobilizing sustainable finance. But in order to really scale, there needs to be some frameworks and guidance around regulations and policies. And Anthony, being from the SFC, I see SFC are very at the forefront in terms of leading kind of like the frameworks and standards that's required to really mitigate potential greenwashing and ensuring a credible kind of like transition pathway. And we've seen kind of like a growing kind of like backlash, I guess, in the US with ESG funds. So, when we think about the trajectory of green finance here, like in Hong Kong, and setting the forum and stage to be an international financing center, what's coming down the pipeline, I guess, and what should market players be aware of?
Just in terms of the regulatory landscape in Hong Kong, I think it's important for the regulators to set a framework for market players. For example, I think since 2022, we have issued a fund manager code of conduct changes in order to mandate fund managers to take climate risks into consideration when they are assessing the risks of their strategies and their funds. And so this goes to the assessment of the relevance and materiality of climate risks, their governance, investment and risk management, and disclosures. So I think I'm just trying to set a stage on how regulators can play a role in this journey. And I think for in order for regulations or changes in policy to happen, there needs to be a consensus in the industry. And I think from there, I think the regulators can help to make it happen, I guess. And so, for example, during our consultation on the fund managers' code of conduct in terms of climate risks, I think there are still some pushback on such requirements, because certain smaller funds might think that their clients are not interested, or there's no appetite for climate risk. So there needs to be a consensus in the industry for us to drive the regulatory changes. And I think the other role that regulators play is in the driving certain initiatives within the industry. For example, I think I was just talking to Jenny last week. We actually launched a calculation tool, an estimation tool for greenhouse gas emissions. And so from there, I think we are hoping that the tools can be used by SMEs to calculate their GHG emissions. And this is only a small step, and it's step one towards a more data availability in the industry. And hopefully this will help the Scope 3 calculation for all the participants in the industry. And apart from that, we do a lot of education. Our subsidiary, which is financial education council, actually provide a lot of education programs to help with capacity building in Hong Kong. The government also provide a lot of support in terms of providing reimbursement for professionals looking to take courses in sustainable and green finance. I think those are some of the general areas that the regulators can play a role, and I will pass on to Jenny.
Yeah. No, I think it's really excellent to see the SFC being very progressive in terms of shaping and setting cover the strategy and providing the tools. I think that's very much needed, but not just for corporates, but also for SMEs to really be able to transition to net zero. So, from a banking perspective, Jason, how is Citi, I guess, responding to these climate related regulations policy, and and how are you working with your clients, I guess, to help them with the decision-making process and allocation and mitigation?
Well, firstly, thank you for having me here. It's a pleasure to be here. I mean, I think the regulation is obviously fundamental, but I think the way we have to look at it is that the regulation provides the framework for something fundamental, which is happening, which is much bigger than that. So we're not responding to the regulation. The regulation is sort of providing the guide ropes, if you like, to make sure that this is done in an efficient and proper manner. But I mean, it would be hard to overstate the impact on this on us as a financial institution. I mean, if you were talking about some numbers earlier. I mean, if we look at climate finance alone over the last few years, that's run between sort of 600 and 900 billion a year. Last year, it actually grew to 1.4 trillion. But we're talking about needing to get that to somewhere between 5 to 10 trillion, and beyond 2030, probably 10 trillion and up. So, in terms of the scale of this opportunity, it's absolutely vast. And it isn't just financing the new, it's also managing what that replaces, if you like, and what gradually starts to decline or disappear. And we also mustn't fall into the sort of mistake of thinking that this is kind of all about energy, because naturally our minds go to wind turbines and solar panels and things like that. It's not. I mean, we obviously all started with energy, but then that attention radar has moved through what we call the hard-to-abate sectors like steel, cement, freight, aviation, shipping, etc. And now we've moved round into food and ag. which is about 30% of emissions, and then we've still got the built environment to look at sort of after that. So it encompasses all of these industries, it encompasses all of their supply chains. So you know, in terms of our business directly, we have a target to facilitate $1 trillion of investment by 2030. We're well ahead on that from where we ought to be on track at the moment. That's 500 billion in climate, 500 billion in social related enterprises. But you know, the last point I would make, right, is that you know, this is a massive opportunity. The interesting thing is that normally what you're trying to do with things is to find the money to do stuff. But as a financial institution, the interesting thing with this is that not only are the sums of investment needed vast, but the fact is that the capital is there and it actually wants to do this. The challenge at the moment is effectively a lack of bankable projects, right? It's matching the risk appetite of the capital with the risk profile of where it needs to be invested. And obviously that is, you know, our job is to facilitate that and make that happen. So it's absolutely fundamental to what we do, and it's absolutely fundamental and front and center of our clients' minds. So hard to overstate the impact.
And I'm just going to follow up with one question, because I think it's a really important point that you made just now in terms of bankable projects. I mean, what does that look like? And what is a bankable project? Because I think, like you said, the capital is there, but how are we going to connect that with the enterprises that are looking for the capital?
I mean, it's a huge question. I know it's at the heart of what we're trying to do today. But simplistically, the argument used to go that, you know, if you take GFANZ, for example, and everybody would talk about the $130 trillion of AUM that was in there, the traditional argument was that was essentially all developed market pension money, insurance money, etc., with a relatively low risk appetite. Whereas if we look at where vast amounts of this investment needs to happen, a lot of it is often in sub-investment grade regions of the world. If we also look at where the money is coming from in terms of public versus private, most emerging market is coming from public. All adaptation, pretty much 97% of it is coming from public money, whereas most of the private capital that's going in, that is going into developed markets. But even in developed markets, it's still only about half private capital, half public funds. Now, if we look at how sovereigns are fiscally constrained around the world, we're never going to hit those numbers that we were talking about unless we can mobilize private capital. And in a nutshell, the answer to your question is we've moved on from that risk match argument to saying, well, right, we know how to do that via blended finance and all those sort of things. What's missing now is actual projects. And there's a report we published recently looking exactly at this, called Mobilizing Climate and Development Capital. And it essentially says what governments are doing is coming up with concepts rather than projects. So typically a banker will expect to rock up and see a data room with 30 feasibility studies and, you know, et cetera, whereas what's coming out from the sovereign side is kind of concepts. So on the sovereign side, we need to engage in capacity building and creating an enabling environment so that capital can flow. The other big piece of the puzzle in the middle, which we've written extensively on, is looking at MDB reform, the multilateral development banks, so that, because that's such an important piece of the puzzle. So using their data, making their data more widely available so that risk is priced more correctly. So it's getting the sovereign side, the public sector side of this, to think more in terms of a project thing rather than a big overall plan. Private sector to engage, and the MDBs to facilitate rather than necessarily investing holistically in this, so that they act as an integral part of blending the capital, elevating the underlying risk worthiness of the capital, and allowing that private capital in.
No, that's really interesting points in terms of looking at the blend of finance and looking at how we can de-risk kind of like some of these investments, and also in emerging kind of like, I guess, innovation and technology. And I guess moving on to Justin, in terms of from a Northern Trust perspective, you know, how are you helping your clients with their kind of like, I guess, investments or achieving kind of like the transition to net zero?
Yeah, we our asset servicing business looks after about $12.2 trillion of predominantly pension fund, sovereign type fund activity. So we're of the least risky side of that investment curve in terms of putting those assets into projects. And the challenge for our clients is actually identifying projects because they just don't exist. Back to Jason's point. So I think really that discovery phase and being able to create joins between data, joins between capability sets, and financing is absolutely key for our client base. So they are looking at how to invest across these particular vehicles in the right risk way, using the right risk parameters. And currently there is still a gap, we think, between the project makeup, the articulation of the data, and the regulatory frameworks across different jurisdictions to demonstrate that value. So this is the value we need to bring to the table to make the numbers real that were mentioned there. So at the moment, we're starting to see a bit of a sea shift in terms of our clients asking, how do we facilitate those conversations? How do we discover projects? How do we discover data to support those projects? How do we bring in the finance guys versus the pipe work? We were joking, and I'm a plumber. I do infrastructure and pipe work. I provide data governance. I provide flow of information against regulation. I'm not the financier here, so I need to join together with Jason. I need to join together with the regulatory frameworks and create a platform that demonstrates that governance to allow large institutional investors, pension funds and sovereigns to come to that table and manage that risk in a risk-averse way and actually being able to invest in these projects. So from our perspective, they're there, they're ready, but they need to have the correct plumbing and pipe work and have these projects demonstrated to them that can fit in a government framework that's supported by their investment profile.
I mean, I think you've hit kind of like a number of points there in terms of needing data, kind of like the regulatory and also the right financing kind of like framework in place to basically really kind of like support these clients. And I guess, when going back to Jason, I guess when you're looking at kind of like funding and financing these investments, is there a platform, I guess, that you can help support your clients in terms of these investments into new emerging technologies, that they will need for their kind of like transition?
I mean, again, yes, it's a huge question, and yeah, it's absolutely at the heart of what we're doing, right? Because we exist essentially to raise capital for our clients and to facilitate liquid markets in whatever instruments or facility that may be, and that runs across every instrument or facility that we're offering to clients. I mean, it's absolutely not our job to preach to our client. They're our clients, but at the same time, we do have a corporate responsibility. We also have shareholders, and we have a social responsibility as well. We've had a net zero target for many years now, and what we're doing now is working through the granularity on that by different sectors, as many other financial institutions are, and we've done that for 6 industries now and laid out what those pathways look like. And in I guess in some ways similarly to a regulator or a public sector entity, what's important there is signalling a clear direction and sticking to that. So from our perspective, what we're doing with our clients is we help them very much with the data side, and we do have a very good picture of the world. Everybody's struggling with Scope 3 at the moment. I mean, our Treasury and Trade Services businesses moves about $4 trillion a day around the world. And that's just sort of trade finance. So this whole point about carbon that's embedded in supply chains, we have a good picture of that. Helping them with data, helping them understand it, but also helping them understand what those kind of transition pathways are for different industries. My particular part of Citi, Global Insights, provides thought leadership in terms of what's happening here and the technologies that are out there and the capital and ways of doing this. But what we have to be very clear is what we're financing, what we're not financing, and at what point are we intending to stop financing X. So this isn't about coming out and virtue signalling and turning the tap off. One of the key points here about transition finance is that companies need capital to transition, right? But at the same time, you need to be sure that they are transitioning. So we're very clear about what we'll finance, what we won't finance. We will finance transition. We will help with that plan and all of the instruments that come from that. And that isn't just, green bonds. That's, sustainable supply chain finance to RCFs to everything. And work with them to achieve that transition, because 90% of our emissions, more than 90% of our emissions, is our financed emissions, right? So if we've got a net zero target, we need the clients to do that. But also, we've got to be mindful that if the world does this and gets to net zero by 2050, if we don't transition, this isn't just about managing risk. This is about opportunity, right? It's about seizing the growth businesses of the future and managing risk and exposure to businesses which, if we do this, are going to be less significant in the future.
And I think what happens if we can't, or the company cannot get to net zero, for example. I mean, I think here, Justin, like the Northern Trust, you have like a few solutions in terms of potentially for those high emitting sectors where there are residual carbon emissions. There are new technologies or integration that your firm has been involved in that can help solve for that.
Yeah, I think if you look at a 2050, 2030, there is a transition to net zero for every firm. And not every firm will get to a net zero anyway. So there will be a percentage or element of that strategy that will involve, hopefully, an ever diminishing offset of carbon credits within that particular model. And I think also as part of the investment in the sector to get to net zero as well, an investment in projects that will actually create a better environment, e.g. a more holistic global net zero environment as well. We're starting to deploy technology that will allow the clients to take carbon credits directly from projects, not through trading desks, which is the more traditional way, and bilaterally invest in projects and then return more to those projects to invest more in terms of net zero reduction. Now, the important thing was we looked to deploy those technologies is to make sure that we create that risk-adverse environment and that transparency and that governance by deploying that environment. Because if we're working with a government, if we're working with a large project, we really need to make sure we're evidencing that the carbon reductions that they're stating are actually happening and materially being passed back to the investor in those carbon credits. Because otherwise, the whole integrity of that chain falls down. Very similar to the transition model in terms of the finance model. If you're not transitioning, that investment isn't worth the investment or the target objective. So we do create a technology-led chain. I mean, ours is as tokenisation, probably very relevant to the last panel, where we're tokenising those agreements and making sure that the evidence of reduction follows through all the way to the carbon reduction being taken by the end investor. So that may be IoT on a direct air capture device that's actually then, as soon as the carbon dioxide goes underground, put in a well or whatever is required, then that carbon credit comes off the net target. Now, it's really important to have those governance structures, I think, as we go forward. Otherwise, you're not going to have that trust in that network. If you're looking across all different sectors, that applies as well, all the way from large government type ITMO projects, all the way down to smaller projects that could be working within SME environments. So we're just trying to make sure that we can get a bit more peer-to-peer connectivity in that particular environment, get that refinancing back into the projects that reduce carbon emissions, but also give the opportunity for the firms that are our clients who want to hit a net zero target or may have a 95% objective to get to net zero and require some supplementary carbon credit offset as well. But the technology's there now, the governance there. I think the capabilities of us demonstrating the link to the regulation is there, and that will certainly help the reporting requirements going forward, because that will provide transparency as well. So we think that's a great use of infrastructure. I touched on plumbing earlier, but that plumbing can enable both the finance side, the net zero target side of our clients as well.
And sorry, and just to recap, so the whole technology platform is in existence right now. It's up and running. And what size do you see? What's the potential size and opportunity of this market?
It's a couple. That at the moment is sized $200 billion at this current for the 2030 target. That could be significantly higher, and that's on the voluntary carbon credit side. Obviously, if you start to look at sovereign, that could be multiples of that amount.
And is it by which regions does that cover? In terms
that is fully global.
That's global.
So so there isn't a limitation. Generally, it's developing countries again. A lot of the carbon opportunities, depending on what level of carbon reduction, are through developing countries. There's significant investment in Middle East. We're seeing a lot of things. Direct air capture plants is a global phenomenon. That's something that there isn't a particular a jurisdictional requirement for those different capabilities. So projects can vary from avoiding deforestation all the way to high quality grade type carbon projects such as direct air capture. We're trying to focus on the scientific. So if I can add an IoT to a well that's you're depositing carbon dioxide into, I have much better governance than if you, for example, were just using a self-attestation of a forestry project, for example. So the more scientific you can get, the more governance you get, the more transparency you get, the more value you get for the project as well, the more investment back in, but obviously the higher grade and the less risk in terms of the credit as well.
And have you seen quite a pickup in terms of demand from your clients for this technology?
Yeah, I think to be fair, our clients are still working through their 2030, 2050 strategies in terms of their own net zero targets. So we're developing slightly ahead of the market there. There is no lack of interest. There is, and again, this is a transition industry already. The carbon markets have matured into a very unstructured set of organisations that work in quite a disparate way, with hardly any standardisation and not a lot of standard reporting. So again, having better regulation over the top of this and more modern technology is going to help this market, because I think it's disrupting itself at the moment already. So great opportunity, and I think it's just really starting to pick up in terms of opportunity set. But we have no shortage of projects talking to us at the moment, and no shortage of clients looking for demonstrable value. Yeah,
no, I can imagine. I think, as the regulation and the market is evolving and it's changing, like literally month for month, as well as we need continuum of I guess enhancements around policy regulations. Not to say that's what people are hearing to, but to actually create, I guess, a data rigor, comparability. Again, I think also more importantly to mitigate kind of potential perceptions, I guess, of some people for greenwashing. So moving back to Anthony in terms of the engagement that you've mentioned earlier with the SFC and some of the key stakeholders providing some data and tools. What additional regulations can we expect to see in the next 12 to 18 months as particularly around, I guess, assurance, and looking at, how data providers are also code of conduct and expectations?
Yeah, I think during the discussions just now, I think both Justin and Jason has talked a lot about data, availability of data, and transparency around these bankable projects. And so I think data, as we all know, is a very important fundamental building blocks. And so from our end, I just talked about the calculation tool, estimation tool. So it was launched last week. And so we're hoping, for example, some SMEs, if they have trouble calculating their greenhouse gas emissions, then they can use this free tool available on the website just for their calculation. And we hope that this will make the ecosystem flourish, and with more data available, then Scope 3 can be achievable, I guess. And that's on the calculation tool and estimation tool. And then on the data provider side, I think we are sponsoring and also supporting initiative to draft a code of conduct for ESG service providers. ESG service providers means any firm that is providing data, providing ratings on ESG related features. And so from that end, we see from a global perspective, there are different approaches. Japan, Singapore, Hong Kong, UK are drafting a voluntary code of conduct to set out conduct expectation of these service providers. When we talk about conduct expectations, we're talking about transparency, i.e. whether their methodology of collecting the data is transparent. How do they report these data? How do they estimate their data? Conflict of interest. When they collect data, when they provide these data, are they also providing consultancy service on the side? These kind of conduct expectation will hopefully make sure that the conduct of these service providers are up to standards, and they are providing best services that they can. And so in that sense, we are this drafting of voluntary code of conduct is ongoing right now, and we're hoping that for the next, it will be issued during the next, the second quarter of this year. And I think another thing in terms of data, I think corporate disclosure is going to be key. Hong Kong Stock Exchange is working to incorporate ISSB S2 into listing rules to encourage listed company to get a head start in terms of climate-related disclosures. And Hong Kong as a whole has a longer-term strategy to make sure that there's a Hong Kong standard that's aligned with the ISSB standards. So there's a cross-agency group that is driving different initiatives in order to make sure there's a Hong Kong standard that's, for example, reporting, assurance, capacity building, and relevant building block for this Hong Kong standard. I think that's a lot of initiative that we are taking in Hong Kong from a regulatory perspective.
You know, I think one of the key points here is that whilst it's a Hong Kong standard, it's actually very much aligned to international standards. And then that goes back to having operability, comparability, and also for Hong Kong to be positioned as like the international financing hub. And I guess, Jason, from your perspective in terms of looking ahead, what do you see as some of your key areas of focus in the next 12 to 18 months?
I mean, I think the first thing to say, and it won't have escaped anybody's notice, is there's quite a lot of elections happening in the world over the next year, and we'll all be, acutely aware of how that can in conjunction with, should we say, a more challenging economic backdrop than we had a few years ago. We've got a lot of these geopolitical tensions. There is, and it varies a lot depending on where you are in the world. But there is certain regions of the world, there is a bit of an ESG backlash going on, and that's sort of pushing back against what I think of as the old model, as this sort of box-ticking mentality of, here's 160 metrics and do that, rather than focusing on sort of materiality and forward-looking things. So I think the first thing to say is that, there will be some pressure. I think the important thing is to see that for what it is, which is pressure on something which is going anyway, right? The fundamental themes behind sustainability, and I think we need to start talking about sustainability rather than ESG, right? They're not going away. If you look at the UN Sustainable Development Goals, you've got poverty, food and hunger, water, climate change, biodiversity loss, infrastructure, decent work and economic growth. These are all fundamental issues, and they were all fundamental and front and center at Davos, for example. So I think that's the first thing to say, right, is to bear that in mind, that this isn't going away, and to see that pressure for what it is. Second point, I think, is what we mentioned earlier, which is looking at this sort of bankable projects thing, and in particular in there, I think there will be a lot of focus on this MDB reform, and looking at the DFIs, the development finance institutions in there. And then the last thing is, I think we're going to see some new themes coming through as well. So I mentioned earlier about, moving from energy to hard to abate to food and agriculture. That is bringing in this whole sort of biodiversity debate as well. We've talked sort of around the edges, if you like, about the TCFD, the Task Force on Climate-Related Financial Disclosures. Last September, we had the framework for the TNFD released, Task Force on Nature-Related financial disclosures. If you think TCFD is complicated, you haven't seen anything yet, right? It's like there isn't the equivalent of a ton of CO2. We don't have a castle on the hill, which is 1.5 degrees, etc. So, there's a lot of work looking at that in terms of tokenization. That is going to drive a huge amount of attention on resources, and I think the last thing that I would say that is going to come out of that is a massively increased focus on the circular economy, which is one of the SDGs that hasn't been looked at a lot, and that's not separate to the climate debate. It's just pulling all of this sort of nature, biodiversity, climate, resources together. So I think we'll see a lot more focus on that and pressure on companies, or if not necessarily to actually start reporting, they'll have to start, or they will be being asked questions by institutional investors.
And Justin, do you agree with that kind of like outlook? Is that how you're positioning and also kind of like working, your innovation and I guess technology steer in that direction?
Yeah, I think for both Anthony and Jason's points, you do need to rethink how the current value chain works to some degree. It's not changing the actors, it's changing the confidence in how we are deploying solutions into the value chain to make a significant difference. And if we're going to accelerate that change and try to get to where we need to get to by 2050, earlier would be better. We need better mechanisms to get investment. We need better mechanisms to report those. We need to give firms better mechanisms to enable investments into new structures and new opportunities as well. So just having my innovation hat on rather than a policy or regulation hat on here, I think there are technologies and there are ways to do this and better ways to do it than there are currently now. And our clients are very interested in doing that because they want to see material results feed directly back through to their investments earlier, but also their own net zero targets. These things are not mutually exclusive. They have their own objectives they've got to meet as well, and they're investing into things that have the same sets of objectives. So it's a common problem they're trying to solve. So reusing the data, reusing the standards, reusing the legislation, reusing the financing models, and just thinking about how that goes all the way through the value chain, it becomes much more understandable, much more investable, and it can accelerate into that. But also, these are the new industries that are going to develop return. That's no doubt about that as well. So the quicker we get these online and the quicker we can supplement some of the sort of the legacy environments, I think will be better. So I'm a real advocate for technology and innovation. I think it's a perfect time to apply technology and innovation to a current a problem statement that needs resolving quite quickly. And if we carry on the way we historically were trying to resolve these problems, I don't think we'll get there in the timeframes we need to get there. So I'm very optimistic, having invested in this space and seeing some of the returns that we can get through having some better plumbing to start with, and then actually some good regulation and some good financing structures as well.
Yeah, that's great. No, thank you. And I'm just in the interest of time and really wanting to open the floor up to Q&A.